Hi, I'm Lydia.
And I'm Aimee, and in this presentation we will discuss what we think a client who has inherited £100,000 should do with their money to ensure that they can balance growth, risk, return and liquidity. Our client's key concerns are that they want to balance liquidity and growth, they want to understand the tax repercussions on their investments, and they want to be able to manage risk while maximising their return. Liquidity is the speed at which an asset can be bought, sold or converted into cash. Growth means to have high returning assets, however, the greater the potential on an investment, the greater the risk. Risk management means to minimise the risk of loss for an investment.
Our recommended portfolio takes a balanced approach to achieve clients' goals. We have allocated 30% to equities, 30% to bonds, 20% to cash equivalents and 20% to real assets. Investment option 1 is into stocks and shares. Stocks represent shares of ownership in a company. This means that investors can benefit from the company's growth as they can earn a profit through dividends. It's important to pick a steady company as the value of stock can increase or decrease based on the company's performance. Although there is a high volatility risk, stocks offer a high potential return. Stocks would allow the client to diversify their portfolio as they would invest in a range of companies in different industries. By having this, the overall risk is lowered for the clients, as if one stock underperforms, others may do well. Stocks also allow flexibility and some stocks pay out dividends. Investment option 1 into stocks and shares is Apple. Apple is a great investment opportunity. It has a loyal customer base and is market leader operating in the technology sector. The annual dividend yield is 0.5 to 1% and one share is £156.44. If our clients invested £10,000 into Apple a year ago, they would now have £11,668. If our clients invested £10,000 into Apple 3 years ago, they would now have £15,071, and 5 years ago, they would now have £28,220. Second investment into stocks and shares should be into Tesco. Tesco is a leading supermarket in the UK, dominating 20% of the retail sector. It's a defensive stock, meaning even in difficult economic conditions, it will still do well as people will always need food. The annual dividend yield is 3.59%, and to have one share it is £348.50. If our clients invested £10,000 into Tesco a year ago, they would now have £10,350.56. 3 years ago, they would now have £11,051.68, and 5 years ago, they would now have £11,752.80. Our third investment into stocks and shares is Coca-Cola. Coca-Cola operates in the beverage sector of the market, dominating 40% of the industry. The annual dividend yield is 3 to 4%, and one share is £73.18. If our clients invested £10,000 into Coca-Cola 1 year ago, they would now have £12,921.70. 3 years ago, they would now have £18,614.80, and 5 years ago, they would now have £24,496.80.
The risk and return analysis of stocks and shares. For Apple, the risks are high volatility, they are highly liquid, and they are a long-term stock. The return for this is 18 to 20%. For Tesco, the risks are medium volatility, they are market risk, and they are operational risk. For Coca-Cola, the risks are low to medium volatility, the market risk, which are health concerns, regulation risks can change the bottom line. For Coca-Cola, the returns of this are 6 to 8%. Tax of stock/equities. For Apple, there are no tax for up to 5 years. There are no capital gains tax, dividends tax or transaction tax. The return for this, however, for the first year would be £1,060. For 3 years, it would be £1,172.36. For 5 years, it would be £1,296.64. For Tesco, they don't have to pay any capital gains tax, any dividend tax. However, they do have to pay transaction tax for the first year, which is a £50 stamp duty tax. The returns for this would be, for the first year, it would be £820. For the third year, it would be £887.24. For the fifth year, it would be £959.39. For Coca-Cola, the tax would be capital gains tax, which they don't have to pay. They don't have to pay dividends tax, and they don't have to pay transaction tax for up to 5 years. The returns for this would be, after the first year, £810, for the third year, £875.61, and for the fifth year, £946.54. Our second investment would be into bonds. We have chosen to put 30% into bonds. What are bonds? Bonds are debt securities issued by businesses or governments. They raise capital, and when you buy a bond, you're basically lending money to the issuer in return for regular interest payments for a specified amount of time. When the bond term is ended, the issuer repays the original amount of the bond. This would be a good investment for the client as they are less volatile than stocks and allows the client to have a steady stream of income and a safety net in case the stock market declines.
The first investment into bonds would be a government bond with a 10-year gilt. Owning a government bond is effectively lending the government money that they'll have to pay back, and with interest. It allows for a steady and predictable income with high liquidity. The annual dividend yield for a government bond is 4.52%. If our client invested £10,000 of his inherited money, by the end of the year he will receive £10,452. After 3 years he would have received £11,409, and after 5 years he would have received £12,460. Our client will invest 10% of the money he inherited. This accumulates to £14,802 after the 10-year gilt and before tax. The second bond is a premium bond, which is tax-free and has no fees. They're not a typical investment, as it's more like a savings product. Instead of earning interest or dividends, the owner is entered into a monthly prize draw, so the return will come if the client won the prize. The more you invest, the higher chance of winning. The odds of winning are 24,000 to 1. The money invested is government backed. They are highly liquid and have no penalties for withdrawal. They're low maintenance, have no regular returns, and the client can win up to £1 million. However, even if they don't win the jackpot, they can still win smaller prizes. Tax analysis of bonds and risk and return analysis. The tax for government bonds through the years are none. Our clients after the 10-year gilt will have £14,802 and therefore will be taxed by 20%, leaving them with £11,841.60. The client will have received an additional £1,841.60 on his initial investment after the 10 years. Premium bonds and government bonds, the risk and return. The risks are that as interest decreases, the bond price will rise. Interest increase equals negative return rate. Low liquidity equals price volatility. There is investment risk. There are low odds on premium bonds and no guarantee. However, risks are low, especially for government bonds. The return is a government bond yield of 4.52%, and there are high government returns.
Investment option 3 is cash equivalents. What are cash equivalents? Well, they are highly liquid, they are only small investments, they have minimal risk, they are short term, and they are used to preserve capital. Investment option 3 is a cash ISA. They have high yield. It's a high yield savings account. It can be very liquid depending on what one is picked, fixed rate or easy access. FSCS protection, very safe option that maximises savings. Interest is tax free up to £85,000. Our client will invest £20,000, which is 20% of his inherited money, into a cash ISA. IRR rate is at 4%. After 1%, our client would have gained £800, which is a new balance of £20,800. After 3 years, our client would have gained £2,497, which gives its new balance £22,497. After 5 years, our client would have gained £4,333, which is a new balance of £24,333. The risk and return analysis of cash equivalents. The risk, there is very low risk as it is FSCS protected. The returns, low returns as they are normally around 0.5 to 2%. Investment option 4, real assets, gold, 10%. Why is gold a good investment for our client? Gold is very liquid, which is a good safety net. They hedge against inflation. It's a safe asset in terms of economic downturn, especially against stocks and bonds, which reduces the overall portfolio risk. In long term, gold increases in value, and there are multiple ways to invest in gold. What is the best way for our client to invest in gold? We believe that it would be physical gold, as the client would have direct ownership over the physical gold and is a tangible asset.
The risk and return analysis for gold. The risks include that there is a lack of income generation if not being sold. There are storage fees of 0 to 1% of value. They might have to pay for insurance depending on where you keep it, home or bank. They're very liquid, but transaction costs usually apply. They have a CTG tax of 10%. Our client will not get taxed though, as he will not make enough profit to meet the threshold of £3,000 in profit each year. We predict him to make £672 after the first year, as the annual growth rate of gold is 6.72% annually. The return can return up to 6 to 8% per year. No tax needed if the sale of gold falls under the exemption limit of £12,300, and it is a safe haven asset. Real assets being cash. We think our client could invest 10% of the inheritance into this. This will allow the client to pay off any previous debts, have a rainy day fund and build up their savings. However, we think it's important to have this liquid safety net to ensure that he doesn't need to pull out of any of his investments so he can earn more money in the long run. There is a negative though. Unless he chooses to put it into a high interest savings account, he won't make any profit off it.
Efficient market hypothesis overview. Strong form. Prices come from information that is public and private, no movement as a result of announcement. Semi-strong. Prices come from information that is public, it will respond to announcement moving up, down and not moving. Weak form. Prices come from information and data that is historical. Efficient market hypothesis suggests that shares and asset prices are a reflection of all available information.
Key concepts involved in efficient market hypothesis. The random walk theory. Prices of stock change at random without being influenced by the past. This is a weak form of efficient market hypothesis. This is supported because if asset prices are a reflection of all information available, then we cannot predict the change of prices. Arbitrage. Buying and selling assets in numerous markets to minimise risk. There is temporal arbitrage, which is when price changes is exploited from a financial contract. Statistical arbitrage is using quantitative methods to see flaws of prices based on information from the past, and spatial arbitrage is buying the same asset in different locations owing to geographical price differences. Profits can be maximised. This results in asset prices changing owing to exploitation of arbitrage. Implications of efficient market hypothesis on investment decisions. Passive investing, active investing, market timing, risk management, fundamental analysis, technical analysis, and behavioural considerations. Here is a chart showing our clients' investment options being stocks and shares, government bonds, premium bonds, cash equivalents, gold and cash, and the efficient market hypothesis implications related to this. There are issues with behaviour, duration, risk aversion, market sentiment and policy, and bank policies.
Portfolio diversification in the context of EMH. Diversification is when investments are spread across assets to minimise the risk. Risk 1. Market risk. Systematic and non-diversible, a risk that is the entire market or class influenced by external factors. Risk type 2, specific risk, diversible, a risk that only affects a specific company or sector. Here is a summary table of the investment options. We have chosen to say the investment option, the risk level, the IRR, the liquidity level, the fees, and the tax, just to give an overall view. Conclusion and recommendations for client. Diversification. The portfolio is well diversified if we have chosen multiple assets for him to invest in, including stocks, bonds, physical assets, and cash-based investments. We have also ensured that we have provided diversity within the investment. For example, the stocks are spread out among different sectors, so if one stock crashes, the other stocks will be unaffected. Risk versus reward. The investment in stock/gold will allow growth potential, while government bonds and premium bonds offer security, and a cash ISA and the cash in the bank are safe and easily accessible. Tax efficient, the premium bonds and tax ISA allow no tax on interest and prize. The stocks and gold are subject to capital gains tax, but only if they make over a certain amount, which is unlikely, but the dividends are usually within the £1,000 tax-free allowance. The liquidity, a lot of investment we have suggested have medium to high liquidity, plus we have kept out a £10,000 emergency fund for our clients. Thank you.